What did the chairman write yesterday? We knew this was coming, but the scathing notes I have read from selected economists have startled me. What did he do yesterday?
But what he did yesterday was he basically changed the inflation objective of the Federal Reserve. Before, the Fed followed what's called a bygones policy. Every year they tried to hit 2%. They missed for 5 years, 10 years, 100 years, 1,000 years. Next year was always to try to hit 2%. Problem with doing that is if you keep missing on one side, inflation expectations become unanchored. And that was troubling the Fed. The Fed hasn't had trouble hitting 2% objective on inflation for many years. And so basically the Fed has shifted and said, now, no, we don't want to hit 2% every year. We want to hit 2% on average. So if we underperform inflation for a bunch of years, then we need to have inflation above 2% for a while in order to keep inflation expectations around 2%. That's really what this whole shift is designed to keep inflation expectations well anchored at 2%.
Well explained. If we combine Angus Madison on demographics and population with Alan Meltzer on the history of your institution, a simple question has to be asked. If we assume a lesser nominal GDP, if we assume a more dampened economy, why don't we just lower the 2% target to 1.9 or 1.8%? Why not do that?
Well, the reason why the Fed wants to have an inflation target of 2%, not lower, is they want to have enough room when you end an economic expansion to have the nominal interest rate high enough so there's enough room to cut rates to stimulate the economy and get the economy out of recession. Let's say the inflation target was 0. Then the peak short-term funds rate would, at the end of the cycle, might be 2 or 3%. There wouldn't be much room to cut rates, and therefore there wouldn't be much way to actually stimulate economic activity.
Was Fed Chair Jay Powell essentially writing the obituary for the Phillips curve, this relationship that previously was believed that if you get unemployment lower, that will lead to a rise in inflation?
I wouldn't say it's quite the obituary, but he's basically saying that we are now going to focus on inflation to guide when we tighten monetary policy, not the level of the unemployment rate. So they changed the language with respect to their employment goals rather than deviations around their employment goals. It's now shortfalls. So they're basically saying that we'll push the unemployment rate to whatever level we can as long as inflation is low. We're going to keep going. Before, in this last cycle, we actually saw the Fed start to raise rates even before we got to full employment.
So we are getting inflation in certain areas, and we were talking about this earlier in the show. Certainly asset prices have gotten incredibly inflated and continue to do so on the promise that the Fed will keep rates low. How concerning is this? At what point does this have to take to make the Fed take stock and raise rates?
Well, I think that they are a little bit uncomfortable with the fact that asset prices are so buoyant. But remember, that's also partly by design. I mean, the Fed basically did what they did in March, April, May to try to make monetary policy easy and financial conditions accommodative, and they succeeded. Now, as the stock market keeps going up and up and up and up, that will cause some anxiety about the Fed. But remember, when stock markets go up, stock markets go down, the consequences for financial stability historically have actually been pretty modest. We had the stock market crash in 1987. Lots of economists anticipated there'd be a recession. There was no recession. So I think that buoyancy in the stock market is probably less risky to the economy because it's not all people that use a lot of leverage to own stocks.
Bill Dudley, Robert Samuelson of the Washington Post wrote a fabulous book a decade ago on the 60s inflation, really centering on the theology of Walter Heller and well-meaning people who were trying to contain budgets in the Vietnam War budgets and such. Stephen Stanley of Amherst Pierpont wrote a wonderful essay over the weekend, and he harkens back to the volatility that could be assumed here through what are called stop-go policies. The idea of a Fed that has to adapt. Suddenly, we move away from the Greenspan, careful, sequential policy back towards the Walter Heller stop-go policies of the 60s and 70s. Is that a risk?
Well, I wouldn't put it quite that way in terms of stop-go, but what the Fed is basically saying is we're going to wait until inflation actually gets above 2% before we tighten. What that means is when they start to tighten, they'll probably have to tighten quite a lot. And so, the markets right now are saying, oh, this is great. The Fed's going to be on hold for a very long time. But it also raises the risk that when inflation actually gets above 2% to the Fed's objective, the Fed will actually have to slam on the brakes a little bit harder. And so it does increase the risk of an economic downturn on the other side.
Is the Greenspan era ending? I mean, if Alan Greenspan was of a gradual approach of 16ths and eighths of a percentage point, are we going back with the stop going, as you just mentioned, larger increases? Did the Greenspan era end yesterday?
You know, I'm not sure that Alan Greenspan would necessarily disagree with what the Fed is proposing here, but certainly we're now in a new regime where you don't tighten preemptively just because you think the economy is getting to the full employment. You actually wait to see whether the low unemployment rate actually translates into rising inflation before you actually tighten monetary policy. So it is a meaningful shift. Now, that said, I think the Fed is actually already acting that way today. The fact that the Fed stopped raising rates and reversed course, you know, a year and a half ago, you know, that was partly due to an idea that we want to get inflation above 2%. And that was already it. So we already have seen a shift in policy.
Does the Fed have any control at this point, given where rates are, in actually boosting the inflation rate that they want to boost?
Well, that's where a lot of economists have some skepticism. It's nice to say that you want to get inflation above 2%, but you haven't been able to accomplish that over the last 10 years. And so what are the tools you're going to use to actually accomplish that outcome? So there's quite a bit of skepticism about whether the Fed will actually be successful in pushing inflation above 2%. And the Japanese experience is a cautionary tale in that regard.
Well, they said, I mean, Fed Chair Jay Powell said, we are prepared to use all the tools in our toolbox. And they didn't go on to say what those tools were, and we're all sort of left in the dark. What do you see as the most plausible tools that the Fed will engage next, should there be another leg of a downturn?
Well, I think that they'll do more of the same. They'll do more asset purchases. They'll keep their credit liquidity programs in place. But I think the reality is we have to acknowledge the fact that the power of monetary policy right now to stimulate the economy is pretty low. I mean, interest rates are already very low. The stock market's already very high. Credit markets are very open and accessible. So the idea that the Fed can do more, yes, they can do more, but how much effect will it actually have on the economy? That's why the Fed keeps talking about fiscal policy right now. The Fed understands that the power from monetary policies to support the economy today is pretty darn modest. And what the economy really needs at this point is further fiscal support.
Bill Dudley, I want to go back to the heritage of Berkeley economics. And folks, it's just a fabulous heritage. We know Eichen, Green, and DeLong of now, but the heritage back to the time of Bill Dudley is absolutely extraordinary, from Akerlof on to Sayez and others. Bill Dudley, when you look at the heritage of Berkeley economics, can you say that the speech yesterday will have a global impact, that other central bankers, including Andrew Bailey speaking here in an hour or so at Jackson Hole, that they will have to adjust as well?
I think people generally are understanding more and more that the importance of keeping inflation expectations well anchored. And so I think that's a broadly shared view around the world. So I don't really think that the Fed is sort of in the vanguard here. I think what they're doing is responding to a problem that's been very evident for a number of years.
Bill, what's the statistic above 2%? Where this policy in place, where the sweat goes up among fancy guys like you? Is it 2.1%, or is it a number substantially higher? The tape is rolling.
Well, I think it really depends. I think it depends on two things. One, how long have you been below 2%, and by how much, and how that has then affected inflation expectations. At the end of the day, as they made it very clear in their policy statement, what they care about at the end of the day is keeping inflation expectations anchored at 2%. So the inflation outcomes necessary to do that are what's going to drive their decision making. If it turned out that inflation rising to 2.25% was sufficient to keep inflation expectations anchored at 2%, then they'd stop there. If it turned out that they needed inflation to rise to 2.5% or 3% to get inflation expectations well anchored at 2%, then they'd be more patient.